Okay, welcome everyone. Unfortunately, I recently have realized that today marks our final lecture of the semester because the last day of classes at Columbia is apparently Monday, May 4th. I recently realized that after checking the academic calendar that the last day of classes is Monday, May 4th. So today is our last lecture. We have lost 2 lectures, unfortunately, due to my illness. But I decided at some point I thought like whether I should record additional lectures and make them available to you, but then I thought that it's not going to be fair for you because then I will ask you to watch all these and make you responsible of material that I should have taught, during regular lecture time. So that is why I am planning to record those lectures, but I will not make you responsible of the material that I will talk about in those lectures. So today, whatever we cover by the end of today will basically, be your responsibility for the final exam, okay? And today now you are gonna see, let me share my screen with you. Today I am jumping to chapter 18, which is on taxation, because it's one of the must chapters that should be covered in a public economics course. There are, of course, very important chapters in between, chapter 13 and chapter 12 and 18, which we are skipping right now because the semester is almost over, which are on health insurance, on unemployment insurance, which are really relevant stuff, especially considering the sort of the pandemic that we are going through, the economic crisis that we are going through, in which health insurance is, it's apparent that health insurance is quite important. And also, it's also apparent that unemployment insurance is quite important, especially in the US economy, that more than 20 million people have recently applied for unemployment insurance. So, but today, I want to focus on, by the way, before started discussing the chapter on taxation, the homework 4 is posted on Courseworks. And it's a very short homework, so it's not something that you should worry about. And as you all know, I'm not going to count your worst homework score towards your homework grading component. But still, if you want to work on it, the deadline is the end of the day on Monday, which is 11:59 p.m. on Monday. The deadline is a bit earlier than usual because it's the last day of classes. I don't want to give you an assignment past the last day of classes. That is why I made it due on Monday night. But as I said, it's just 3-question homework, not really very long. You should not have much difficulty to complete it. Now, today I will talk about chapter 18, which is on taxation. And if time permits, I also uploaded slides of chapter 19, but I don't know how much we will have time to dive into chapter 19. But in case we are done with chapter 18, before the end of the lecture, I can also talk very little about chapter 19 as well, which is also on taxation, by the way, on tax incidence specifically, who bears the burden of taxes. Now, taxes is, taxation is a really important tool in public finance because generally governments, as you all know, have different sources of revenue. And the main source of revenue for government finance is, as you all know, taxation. And so in this chapter, we will shortly summarize, how it works, what it means, and, different terminologies regarding taxes we will go through, okay? So what we are going to go through is types of taxation. We are going to specifically look at the, structure of the individual income tax in the US, how to measure fairness of tax systems, how to define tax base and specifically income tax base. And then we are going to be looking at first this Hague-Simmons way of taxing. We are going to define it first, but then the deviations from that. And then we are going to be looking at the appropriate unit of taxation, and then we will conclude. Now, the textbook, the chapter starts with a discussion of, more or less a recent discussion of in early 2000s, where after the end of the Clinton administration in 2000, the US government had a projected federal budget surplus, meaning revenues exceeded The expected revenues exceeded expected spending. And therefore, the president at the time decided that this they should use to reduce taxes. So, of course, federal taxes, not state taxes. And because in the US, as you know, we have sort of this distinction between federal level of taxes and state and city taxes. City and state taxes are decided by city and state government authorities, whereas federal taxes are decided by the Congress. And now, since the Bush administration at that time, the junior Bush administration, decided to lower the taxes, so the Congress supported that, and tax rates, income tax rates, federal income tax rates were lowered at different rates for different income brackets. So generally it was in between 15 to 39.6% before, and then they reduced it to 10 to 35% for different brackets. The estate tax, you know, the tax that you pay for your inheritance, was phased out also as part of the package. And then also, you know, 2 years later, these cuts were further extended in a different act, in a different law passed by the Congress, which also lowered the maximum tax rate on stock dividend, capital gains, and increased the allowable deductions from the corporate tax, which basically essentially lowered the average corporate tax that the firms are paying. And then 8 years later, when the President Bush left the office, the surplus that he inherited from the Clinton administration became a very large deficit, not surprisingly, because the tax cuts lowered the tax revenue substantially. And then during the Obama administration, you know, there was some discussion about whether these tax cuts should end, basically. And of course, some members of the Congress, mainly Republicans, are generally against taxes, so they were against it. And then there was a compromise at the end, where the tax cuts were extended for another 2 years, and then expired again in 2012. And then there was another compromise, American Taxpayer Relief Act of 2012, which basically made all these tax cuts for households earning less than $450,000 permanent, and above that, the tax cut expired and again went up from 35 to 39.6%. The estate tax increased from 35 to 40%, which is quite huge actually, especially compared to, like, for example, Turkey, where I am from, where there is also an estate tax. Like, you know, in a sense, like, you know, if your parents die and they own a house and you inherit it, to get the house on your name, you need to pay something. Those tax rates are really very high in US compared to Turkey, for example. In Turkey, it's really negligible, the estate tax that we are paying. Also, the property taxes are negligible in Turkey compared to US, but it's another story. Okay, so, and then the new administration, President Trump administration, made a further tax cut, and of course, you know, all this. So we are not going to analyze all these details about tax cuts passed by different administrations or different Congresses, but it is just sort of to show you, to motivate you that this discussion surrounding taxes is really important in policy circles. Okay, so we are going to now look at different types of taxation and what kind of a role they play in shaping public policy. One type of taxes is taxes on earnings and individual income. So like one tax that is very common and popular in US is originating from taxes on earnings, which is called payroll tax. So a tax divided on income earned on one's job, okay? This is called payroll tax. You pay that with your salary, you know, automatically it's subtracted from your salary. And then on top of that, we also have taxes on individual income. Even after this is paid by your employer or maybe partially by you, the individual income tax is a tax paid on individual income occurred during the year. and I'm sure that all of you have already filed some taxes in the past, is either this year or maybe last year. You are familiar with that. And then there are also taxes, again, another type of income taxes on taxes on capital gains. If you have some savings account or have some stocks, sell those stocks and earn some money out of those. Or on houses that you may own or that you may sell. These are all capital gains, considered as capital gains, and you are also paying income taxes out of these capital gains. Then there is also taxes on corporate income, which is, basically in a sense, income taxes on corporations. It's called corporate income tax. And then these are taxes on income, but there are also taxes on wealth taxes, in which now you pay taxes on the value of assets, on the value of the wealth that you may own. Examples might be property taxes, for example. It's considered as a sort of form of wealth. Or estate taxes, as you inherit some assets from people who die and, give you bequests. And then there are also taxes on consumption, depending on how much you consume. You may pay sales taxes, which you pay, as consumers to vendors at the point of sale. Or there are also some excise taxes for cigarettes, gasoline, and also, for example, sometimes for cars that you own, you pay to the city some excise taxes. If you are residing in a city or in a town and then you own a car, you pay some tax to the city or to the town. It's also a way of excise taxes. Now, when we look at the tax revenues by type of tax, like what is the fraction of the revenue coming out of all these different kinds of taxes, which is actually very different across different countries. So this is for the US, for the US tax revenue in 2017, separately for the federal government, the state and the local governments, and the total government. What we see is that, for example, for the federal government, the largest fraction is coming from individual income taxes, 44.7%. Then 35.9% come from social security contributions. And then 11.2% is from corporate income taxes. Consumption tax is very little, 2.6%. And other kinds of taxes is 5.6%. And then for the state and local governments, the picture is very different. Individual income taxes are still important, but relatively they are less important for the state revenues. So 16.3%. 21% for property tax, consumption tax for 23.1%. Corporate income tax is very little, 4.4%. And then if you just sum up state and federal, of course, by weighting them appropriately, because the federal government is very large compared to individual states, in total, individual income taxes are really still important, 37.1%. And social security contributions comes next, or along with the consumption tax, they come next, one can say. And then corporate income tax is here and other taxes are here. I think like this is a bit weird because, here the corporate income tax is 6.1% and the others is 8.6%, which looks weird to me. But anyway, the size of this blue pie is a bit of the, I don't know, it's not appropriately drawn, I think. But anyway, so one thing which is quite important is like individual income taxes are quite important for the overall government budget, state plus federal. It is not the case in all the countries there. In certain countries, consumption taxes are much more important than social security contributions and income taxes or corporate taxes, which is not the case for the US. And actually, sometimes people differentiate between two types of taxes, direct taxes and indirect taxes. Corporate income taxes and individual income taxes are counted as direct taxes, whereas consumption taxes are counted as indirect taxes. And generally, the ability of a government to finance most of its spending with direct taxes is seen as a sort of an indicator of how well the tax code is enforced or how capable the government is to collect taxes. Because if a government is relying more and more on consumption taxes as opposed to income taxes, it is seen as sort of an indicator of incapability of collecting taxes, because consumption taxes are very easy to collect, but they have a lot of repercussions, negative repercussions in terms of achieving equality or sort of achieving the purposes of taxes. Whereas income taxes are more corrective in that regard. We will see that more in detail later on in later slides. However, so I'm just trying to say, like, for example, for a country like Turkey, a very large fraction of the state tax revenue, government tax revenue, is coming from consumption taxes. And why? Because the government cannot collect, is not able to collect individual income taxes properly. Okay, cannot enforce those. It's very easy to evade taxes in Turkey. It's not, the tax enforcement is not as perfect as in the US. So that is why, if you cannot collect enough individual income taxes, then you have to rely on other taxes that you can collect. And one kind of tax that's easy to collect is consumption taxes. But of course, consumption taxes are not that fair, because you are not taxing people according to their income, according to their ability, in a sense. We are just taxing them according to their consumption. Okay, so far so good. And this is the international tax revenues by type of tax in different countries. Norway, Denmark. Of course, Norway and Denmark are two countries in which tax enforcement is really still as good as in US, and even maybe better. So it's not like, Norway and Denmark should not be very indicative of the world as a whole, basically. These are, the Scandinavian welfare countries in which tax enforcement is really good, basically. But if you look at the OECD average, maybe it's much better, because as you can see in the OECD average, consumption tax is has the highest, portion. Of course, again, the OECD is generally seen as the country club of the United Nations. That is, sort of a more or less like developed economies, excluding a few. Two countries within the OECD which are having difficult time in tax enforcement is Mexico and Turkey. So maybe it could be better to look at Mexico and Turkey separately than the rest of the OECD. But anyway, because I'm sure, I personally know, in US and in Mexico and Turkey, the share of the consumption tax is larger than 50%. So, which is an indicator of that the fact that these two countries cannot collect income taxes as good as other OECD members. That it's also not very surprising that the Mexico and Turkey among the OECD members are the two countries in which the size of the shadow economy, size of the informal sector, or the extent of tax evasion is highest among OECD members. Now, some additional terminologies. In the case of the income tax, individual income tax in the US, which are relevant to compute the tax base. Tax base is, the base on top of which you are taxing. So like one key terminology is the gross income. Again, those of you who have filled individual tax forms, 1040 forms earlier, might be familiar with all this terminology. Gross income, adjusted gross income is quite important, a key term in 1040 forms. And tax income. Gross income is total of an individual's various sources of income. You just sum of all the incomes. And then generally you are allowed to subtract some deductions or contributions to IRAs. And if you do that, then from gross income, you go to adjusted gross income. And then you can also subtract some exemptions and deductions, and you end up with taxable income. And once you, in the US individual income tax, once you determine your taxable income, then you go, of course, if you are using a software, the software is automatically doing it for you. But if you are doing your taxes on your own, once you finalize your taxable income, then you go to the appendix of this manuals of the tax forms, and then corresponding, you try to find the corresponding tax amount which corresponds to your taxable income. Let's say your taxable income is $100,000, then there is a number corresponding to $100,000 in the tax tables, say $15,000. That's the tax that you should pay according to your taxable income. Of course, if you are using a software, the software is doing it automatically for you. You don't need to look at any tax tables. Then of course, there are a bunch of adjustments that you can, use that vary over time, because, each year the regulations surrounding those may change or may not change. Sometimes there are more exceptions, sometimes there are less exceptions. It's, filing taxes is really very difficult in US. Of course, US is a very different country compared to, for example, if I compare US against Turkey in, doing taxes. Like in Turkey, for example, no individual. Firms are doing that, of course. Firms work with accountants and they file taxes in different dates of the year, but no individual is, of course, no individual working for a company, I should say. If you are an individual working for yourself, or if you own a company, of course, you have to file taxes, but no individuals working for the government or working for a private sector company or for a university, for example, is not filing taxes like in the US, because all these tax deductions out of your salary, out of your payroll, is automatically deducted without reaching even to you. So at the end, you don't need to, fill in any forms, any tax forms at the end of the year or in the beginning of the next year, because all your taxes you are automatically paying out of your salary. The company that you work employ accountants, and those are subtracting whatever your tax duties are. They are automatically subtracting that from your salary in a given year, in a given month, or in whatever. If you are paid monthly, which is the general norm in Turkey, people are generally paid monthly. Monthly, whatever your gross salary is, the taxes are automatically deducted from your gross salary, and you just get the net salary at the end of each month or in the beginning of each month, whenever you are getting paid. And you don't need to do any taxes at the end of the year. Of course, this is a bit weird, because in that case, your net salary changes from one month to another as you are moving up in the income brackets throughout the year. In the beginning of the year, your income is zero, basically, because you are getting paid for the first time in the year in January, let's say. You pay less taxes. But at the end of the year in December, you accumulate all these income and you jump up in the income brackets. Therefore, your tax rate goes up throughout the year and your net income goes down throughout the year. In the US, it is different. In the US, you get paid the same amount mostly. And at the end, depending on what your income throughout the year was, you either pay more taxes or sometimes you get some tax refunds back, depending on, how much you work throughout a year and whether you get married or not, and a bunch of sort of complications. And also, of course, there are a bunch of complications related to, contributions to retirement savings, health savings accounts, student loans, expenses for job-related loans that you can deduct or may not deduct, educator expenses, and a bunch of complications that you are all, I think, familiar with. Anyone who filed taxes in US should be familiar with, at least with some of this language here. And then, to get the adjusted gross income from gross income, that we subtract exemptions and deductions. What do we mean by deductions, or what do we mean by exemptions, is explained here in the slide. An exemption is basically a fixed amount that you can subtract from your adjusted gross income for dependent member of a household, like for example, for your kid. Or there are also deductions that you can use, standard deductions, a fixed amount independent of your studies that you can subtract or deduct, and itemized deductions. If you believe that your itemized deductions end up being more than the standard one, then you choose that, and you can deduct different kinds of expenses, which also changes from one year to another depending on the regulations or the tax code. And In a sense, you are trying to reduce your tax base after all these deductions. I don't want to go into the details of that, but there are other kinds of deductions that you can claim, like medical expenses, gifts to charity, if your car is stolen, whatever, and then there are also other terminologies like tax credits, withholding, and refunds. Tax credit is basically amount by which taxpayers are allowed to reduce the taxes they owe to the government through spending. For example, if you paid for childcare, you can use it as a tax credit. And withholding is subtraction of the estimated taxes owed directly from a worker's earning, which are withheld automatically throughout the year, and you don't need to pay them again. But if you pay too much, you can get back at the end of the year, or if you pay too little, you have to pay more at the end of the year. For example, in my case, last year, for some reason, I don't know why, when I started to work at Columbia University, when I filled in the paperwork in the beginning of my, in my first day of the job, for some reason, they have noted it down as if I am single. So they did not, and then throughout the year, throughout 2019, from August to December, I paid as if I am single. They deducted taxes from my salary as if I am single, even though I am married and have one daughter. And that is why I pay too much taxes, by the way, because if you are single and if you have this certain income versus if you are married and we take it and they have the same income, the taxes that you pay is not the same. But they deducted from my salary as if I am single, so they deducted too much taxes from my salary. And at the end of the year, when I filed taxes in 2020, I could not see the refund number that I have seen, in the tax software that I was using. It was huge refund because and then I was surprised. I thought that I am doing something wrong, but at the end it turned out that I paid too much taxes because my status was showing as single in the tax records. Anyway, so and I got a huge amount of refund at the end. And refund is basically justifying here the difference between the amount withheld from a worker's earning and the taxes owed if the former is higher. So I got a lot of refund. And what is the rate of taxes that you are paying? You may be asking, depending on your income level. So it's from 2018. So as you can see, of course, it changes from one year to another. These brackets on the x-axis change from one year to another. It is basically depending on your level of income, the rate that you are paying is also different. So for your first $19,000, you pay 10%, and then for your income between $19,000 and $77,000, you pay 10%. After $77,000, it goes up to 12%. After $165,000, it goes up to 22%. After 315, it goes up to 24%. After 400,000, it goes up to 32%, and so on and so forth. You see the sort of jumps in the rates. Okay. So we are not paying the same rate for every level of income. Which brings us to the discussion of marginal and average tax rate, which are again different concepts. The marginal tax rate, of course, why do we have this distinction? Because we want to sort of see, generally, all the tax systems are designed such that you pay more for additional income. Not only, you pay more in total, but you also pay more as a fraction. So it is not only, the case in other countries, in US, in Turkey also. Like the tax income brackets are, so for a certain amount of money in Turkey, for example, you pay 15%. After that level, you pay 20%. After that, you pay 27%. After a certain level of money, you pay 35%. And after a certain level of money, you pay 40%. So it changes, depending on the level that you earn. And which brings us now to the discussion, to the distinction between marginal taxes and average taxes. The marginal taxes is the percentage that is paid in taxes of the next dollar earned. So it is not, average tax that you pay, but instead, like, you know, if I am, especially if I am in between different brackets, if my salary increases or if my income increases by $1, the marginal tax rate might really be huge, because for that additional dollar, I jump from one income bracket to another income bracket. On the other hand, the average tax rate is basically, you know, the percentage of gross income that is paid in taxes. So in total, you pay $10,000, let's say, is taxes, and your gross income is $200,000. Then 10,000 divided by $200,000 is your average tax rate. Whatever you pay divided by whatever you earn. Whereas the marginal tax rate is, it may change, you know, depending on your level of income from one bracket to another. Okay. And the marginal tax rate rises with income in US from 10% to 37%, even though the average tax rate is going to be something in between generally. And then, of course, you know, why do we have, again, like, you know, I keep asking these kind of questions, but what kind of distributional goals do we have in measuring tax fairness? Like, why do we have all these distinctions? Generally, the main purpose of a tax code, the main purpose of a tax system is trying to establish vertical equity and horizontal equity. Vertical equity basically means that if you have more resources, then you should pay higher taxes. Like, if you are richer, you should pay more. Okay, basically. The horizontal equity, on the other hand, means that you may be making different economic choices, but at the end, if you are similar in terms of resources or in terms of income, then you should be treated similarly by the tax system. Like, I may be, for example, you know, you and I may be sort of equally rich, let's say, in terms of the income that we receive. But maybe I am earning most of my income from labor, whereas you earn most of your income from capital. I mainly work for a company and earn money. The company pays me a certain amount of wages. And you may be, I don't know, having some sort of two businesses or one small business or two apartments that you rent out. But at the end, you know, we end up having same level of sort of resources. But we are making two different economic choices. I am working, you are doing something else. Horizontal equity means that, again, the tax system should treat us similarly. It should not tax you more or tax me more, just because we are making two different economic choices. If we are comparable in terms of the economic resources that we end up with in a given year, horizontal equity, if a tax system has horizontal equity, if a tax system achieves horizontal equity, then it should treat us more or less similarly. Vertical equity is easy to achieve, like, you know, it's just a matter of the tax code. You can just sort of change the rates, and, you know, you can tax the rich more. It's easy to establish in a sense. Horizontal equity is much more difficult to achieve because it requires sort of a comprehensive approach towards the tax system, towards designing a tax system, because, you know, you need to be very careful about, like, you know, how to establish horizontal equity with all kinds of different economic choices that people may make. Okay. So vertical equity requires progressive taxation. Progressive taxation means you need to increase the average tax rate with income. You need to tax rich more, basically. So tax systems generally can be, with respect to their changing tax rate across income levels. Tax systems may be in three forms. Again, like, if we differentiate tax systems according to the tax rates paid according to different income levels, it can, you know, come up in three different forms: progressive tax systems, proportional tax systems, regressive tax systems. Progressive tax systems mean the average tax rate increases with income. So the marginal income tax rate is positive. For each additional income, you pay more and more. You are paying a higher rate for additional income. And most of the tax systems out there in the world are progressive, by the way. Of course, you know, degree of progressiveness might change from one country to another. Certain countries might have a much more progressive tax system. Certain countries have much less progressive tax system, but both of them can still be progressive. Proportional means the average tax rate does not change. Whatever your income is, you pay 20% of your income as taxes. That's all. Even if you earn $1 million, even if you earn $5 million, even if you earn $50,000, you pay 20% taxes. It's a proportional system. Progressive system means for the first $10,000, you pay 10%. For an additional $20,000, you pay 15%. For an additional $25,000, you pay 30%, and so on and so forth. This is progressive. Proportional means you pay the same rate for any income level, and then the opposite regressive cases, which is not very rare. I don't really know any country in which there's a regressive tax system where the effective average tax rate may fall with income. You pay less in rate. You pay less in rate with additional income. But again, it is either non-existent or very, very rare. I really don't know any country in which there's a regressive income tax system. So, of course, fairness is a very ambiguous term. It's very hard to quantify and hard to achieve. And politicians sometimes try to pick the meaning that best suits them, unfortunately. For example, when this President Bush's tax cut was signed into law, the income tax cut in 2003, it turned out that 44% of the whole tax cut went to the top 1% of payers. Now, it doesn't seem fair just by looking at this number, but then at the end also, this top taxpayers, 1%, was paying 38% of overall income taxes. So maybe it is fair. So, in a sense, these are really sort of hard to justify. And there is a nice cartoon here that you may read, which is quite funny. And there's an example here that we can actually use to calculate the average tax rate if you wish. It's very easy. So suppose a nation has a tax rate of 10% on the first $10,000 of taxable income, 15% on the next $20,000, then 20% on the next $30,000, and then 30% on all taxable income above $60,000. As you can see, this is a progressive tax system because the rate increases with income. And then there is a $4,000 exemption per family member. And there is a guy called Anand, has 8 members and earns $80,000 per year. What is his family's average tax rate? So what you should do is that here to calculate the overall taxes that this guy is paying. So this guy is paying $80,000, but since he has 8 members, and for each member $4,000 is deductible or exempt, so 4 times 8 is $32,000 is the total exemption. So 80 minus $32,000 makes $48,000. So the tax base or adjusted gross income that you can calculate is $48,000 for this guy. And now out of these $48,000, this guy is going to pay taxes. Now the question is how much? So 48 is now the adjusted gross income or taxable income. Now for the first $10,000, it's 10%. So $1,000 for the first $10,000. Then for the next $20,000, it is 15%. So it's $3,000. 15% of $20,000 is $3,000. So $3,000 for this bracket, $1,000 for this bracket, so $4,000. And then now this guy earns in total, as you know, the tax base, so the taxable income is $48,000 for this guy. So 20 for the first 10,000, the tax is already paid in the amount of $1,000. For the next $20,000, the taxes is still paid in the amount of $3,000. So one thing that remains is the $18,000 left, right? Because $10,000 is for the first income bracket, $20,000 is for the second income bracket. Now this guy's taxable income is 48. So 20 plus 10 is 30. 30 is $18,000. So now for the remaining $18,000, this guy is going to pay 20%. So 20% of $18,000 is $3,600. So this guy now therefore will pay $1,000 plus $3,000 plus $3,600. 3,600, 3,000, 1,000 makes $7,600 of total taxes paid. And what is the average tax rate? 7,600 divided by 80,000. which I think should make 9.5%. Is this clear for everyone, how I calculated these numbers? Any questions? $7,600 is the total tax paid for this guy, and divided by $80,000 gives you the average tax rate, which should be 9.5%. Okay, if there are no questions, so let me proceed. Now, of course, like, you know, there is this idea of, or different ideas of defining the tax base, income tax base, in which two guys came up with an idea of a comprehensive income definition, Haig-Simmons. It is basically a definition of taxable resources as the change in an individual's power to consume throughout a year. Okay, so if your power to consume changes over time, the idea is that your taxable base or taxable income base or income tax base should also change accordingly. And then, of course, you know, you can look at the potential annual consumption plus any changes in that. Like if you consume, it means that your consumption level may determine your purchasing power throughout the year. Plus, if you experience any positive changes in wealth, you inherit a house, you buy a house, you buy some stock, or the stock that you buy really, you know, got a lot of sort of appreciated a lot. But therefore, this is a very theoretical definition of philosophical, in a sense, to some extent, definition of taxable income or income tax base. Of course, it is not perfect, as you can maybe realize immediately, because defining power to consume, ability to pay, and defining an income tax base accordingly is very problematic. Because consumption is not necessarily, consumption does not necessarily reflect changes in the income. As you know, like we have this consumption smoothing that we discussed earlier. Even though your income may change, may fluctuate a lot throughout the year, you may be sort of hedging yourself against those income changes with consumption smoothing. So consumption is not equivalent to income. That's why you sort of using consumption as an indicator of income tax base is very problematic. And there are also non-consumption expenditures that you may be paying for. So it's in a sense like this is trying to promote some horizontal equity, like because if two people have different kinds of consumption levels, you may tend to argue that, oh, these guys have more or less similar resources, therefore we should tax these two guys similarly. But as I said, this is quite problematic. And actually that's why I said in the beginning when we discussed horizontal versus vertical equity, horizontal equity is much more difficult to establish, to achieve than vertical equity. And then there are a bunch of sort of other issues like related to non-consumption expenditures like state and local tax payments, medical expenditures. I'm not really consuming medical expenditures because just because I'm sick, I'm paying for it. It doesn't mean that I am consuming healthcare services. And also like another reason for the deviation might be like some expenditures are, as I said, like not consumption, but rather reflect the cost of earning a living. Like for example, sometimes you need to go, you pay, for example, for transportation expenditures to go to your job. Now the question is this cost of business, or if you have a business, there are certain expenditures that you have to make in order to attract customers and earn money. And then the question is, how should these be deducted from the income that you are earning? And then, of course, this brings us to the discussion of what constitute appropriate business deductions. And there are very interesting examples in your textbook where, for example, at some point, a tax court in US accepted the claim by an exotic dancer for breast implant as a business expense. And then a man tried to deduct $30,000 in expense on illegal drugs, for example, which were accepted as tax deductions, but then the guy was sentenced for criminal charges later on. But the fact that it's criminal doesn't make it, non-allowable expense. Like, for example, music artists apparently can count outrageous outfit as business expense. Like in 1970s, this Swedish pop group ABBA was famous for their outrageous outfits, and Lady Gaga wore a meat dress, all of which are tax deductible accordingly, because it's part of their business accordingly. Okay. NFL, National Football League athletes and coaches may deduct league fines as business expense. Of course, sometimes this sort of which is what is allowable, what is not, is really quite difficult to sort of differentiate. But I just want you to make, I just want you to be aware of all these sort of complications. Okay, and now one issue again, which deviates from this philosophical definition of Hayek-Simmons, is regarding charitable giving, because of course taxes also sometimes try to correct externalities, and charities as well, charitable giving as well. Now then the question is whether you pay for charity because of the tax break or not. Okay, so people may be paying for the charitable expenses because generally charitable expenses are allowed to be deducted from your gross income. So whatever you pay for charity, you can deduct it from your gross income. You don't pay taxes for this charitable spending component of your income. And if you don't allow for these deductions, then these would be underfunded otherwise. This is the idea. Like for example, one way could be, okay, so let's do not allow for charitable deductions, and instead the government should pay, should provide some sort of charitable spending. Okay, so and what is sort of the pros and cons of doing that? Either people may be allowed to deduct charitable spending out of their gross income, or if we don't allow for that, and instead the government spends some portion of tax revenue for charitable activities, for example, for homeless shelters, let's say. What is sort of the difference between these two? Now the question is, or the issue is that if the government subsidizes instead of private charities, if the government subsidizes homeless shelters, the amount of the private charitable giving to those shelters would most likely fall. And now the question is, of course, the reality also might be in between, the government may allow for partial deductions, but then the idea is that for each dollar that the government does not allow to be deducted from taxes, now the question is whether that dollar is going to be spent automatically by this charitable activity by the government. And this discussion here basically says that whether there is a crowding out effect of this or not, crowding out or crowding in effect of this scheme. Like when the government tax subsidizes charitable giving, it may crowd in or increase private contributions, and if it does not, it may crowd out it. So this discussion also is quite important here, and especially here the distinction between marginal impacts and inframarginal impacts are quite important. The marginal effects is basically a change in the behavior the government hopes to encourage through a given tax incentive. If the government gives a tax incentive of any kind, generally there is a motivation in mind, or there is a sort of a change in behavior that the government is hoping for. That's called the marginal impact or marginal effect. Whereas the inframarginal impact or inframarginal effect is basically tax breaks that the government gives to those whose behavior is not changed by a new tax policy. Certain tax policies create marginal impacts, certain tax policies don't. And in the design of public policy, in the design of tax policy, this is again something that should be into account. If the main rationale behind the tax policy is creating a marginal impact or not. And then there is a discussion of mathematically whether it makes sense to use a tax break instead of direct spending. Because the issue is here whether the government should tax more and then spend it for the desired activity, whatever the activity is, let's say homeless shelters, versus the government should give a tax break and then should allow private individuals to, charitably contribute to the activity, for example. So of course, it depends on whether this 1% tax break is really going to the charitable activity or not that you give. And of course, there are different kinds of results from different countries. In certain countries, tax breaks might be effective to increase charitable activity, like in the US. In some countries, generally, tax breaks or tax policies, tax incentives are not really effective in increasing charitable activities. One such example of a pessimist result is from Turkey, actually. Of course, it's also related, like how sort of common the charitable activity is in the country, historically, culturally. These are also, quite important in this kind of discussions. Now, also, there is this discussion of consumer sovereignty versus imperfect information. Why? Because sometimes, this direct government provision of a certain activity imposes preferences about how funds are spent. So if you provide something through government funds versus you give a tax break and let people spend the money on whatever they want, including the desired activity that you want, it is like, generally, if you give tax break and if you let people spend for it, you give a more sovereignty to consumers. So like direct government provision, if government just go ahead and provide it through tax revenue, then it also imposes preferences about how these funds should be spent. On the other hand, tax subsidies to private individuals respect the preferences of citizens because it allows you to choose whatever you want to spend it on. But of course, sometimes the private sector or individuals may not have the appropriate mechanisms to ensure, to promote efficient distribution of charitable spending. Because, generally people don't do much research before donating. Of course, this is all like, whether the government knows more on how much we should spend and on how we should spend our charitable donation versus whether we know much better for ourselves how to spend it. So then also, on top of this, there is also tax implications of, or housing implications of tax policies, I should say. Because generally, we pay taxes on our houses, property taxes on the houses. Also, if you own a house and rent it out, then you are also paying some rent. You are making some rent. You are earning some rent revenue, from your tenants. And also, tenants pay rents for the rental apartments or houses that they are renting. And generally, as you know, most of the time, home ownership is subsidized in tax policies in a bunch of countries through the home mortgage interest deduction. So for the interest portion of your home mortgage, in Turkey also we have this, in US as well, you can deduct it from your income taxes. Just the interest portion, or not for the main capital payment. However, rent is not tax deductible. So for example, if you are a tenant and you are paying rent, you are mostly not deducting rent from, in certain state income taxes, in certain states, some portion of the rent payments are deductible, but for the federal income tax, it is not. Whereas if you are buying a house instead and paying mortgages, at least for the interest payment, you can deduct it from the taxes, which is basically creating an asymmetry in favor of homeowners at the expense of renters, right? Of course, this is basically, subsidizing home ownership instead of renting it. Why? Because the idea might be like, home ownership may provide some externalities, positive externalities, through responsible citizenship, and, you belong to the city or town that your house is in, and, maybe there is this idea of like, home ownership should be sort of promoted in that sense. Because why are we allowed to deduct interest payments, mortgage interest payments out of our income taxes, but not at least a fraction of our rent payments? Because there is the idea of like home ownership should be subsidized in a sense, at least relatively. And there is this discussion of whether the subsidy is effective in promoting home ownership. The idea is that it does, okay, from 7 to 11%. But of course, generally it is very difficult to quantify those, but still, oh, sorry, we got back. I'm sorry. Okay, so yeah, there is this idea whether this tax policy is in favor of homeowners, is effective in promoting home ownership or not. It's a bit questionable. Some people say yes, it does. Some people say it does not. Because when we look at the data, what we see is that home ownership is essentially more or less constant in US since 1950s at around 65%. Then there is this discussion of tax deductions versus tax credits, even though they are somewhat similar. Because tax subsidies can be offered as deductions or credits. Deductions is basically you are allowed to reduce your taxable income through spending on these kind of items, like home mortgage interest, charitable donations. You don't basically pay taxes on those. You deduct those from your adjusted income, and you don't pay taxes out of this spending. Whereas tax credit is basically, you are allowed to reduce the amount of tax that you owe to the government by a certain amount. So in one way, in the tax deduction case, you are reducing your tax base, your taxable income. In the tax credit, you are reducing the amount that you owe to the government, which is of course much better because tax credit is much more preferred by taxpayers as opposed to tax deductions, because you are reducing the amount that you owe. Whereas in the tax deductions, of course, the level can be adjusted accordingly. But whether these two are really different, like of course a $100 tax credit may be equivalent to $10,000 of tax deduction. I'm just making up the numbers, but just sort of to give you an idea of how they compare. And still, whether a government chooses one over another is again something that the policymakers should think about. Okay, so there are efficiency considerations of taxes, equity considerations. Since we are not going to have much time to discuss all, we can skip those a little bit. And there is this refundability debate, like whether this tax credit should be refundable or not. There is a discussion about the child tax credit that we can also skip. But the one thing that I don't want to skip is tax expenditures, which is really an important concept in tax policy. Tax expenditure is basically, in a sense, it is like a different kinds of expenditure. Like we have this government expenditures, the government really spending something on it. Tax expenditure is again a hypothetical concept which basically quantifies all the revenue losses of the government due to the tax law provisions. For example, if a new tax policy, a new tax code is passed by the government, passed by the Congress, and it allows a new kind of tax deduction that did not exist before. Let's say, we are allowing individual income taxpayers to deduct a specific activity out of their adjusted gross income. And tax expenditure basically quantifies the revenue loss out of this new policy. Okay, it's called tax expenditure. It's not, something that the government spends actually. It is basically, due to the new tax policy, there is a change there is a reduction in the tax revenue. It is in a sense sort of an hypothetical spending that the government is making due to the new tax policy, because the government cannot collect that tax revenue that it could collect before the enactment of the new introduced policy. And it turns out that, for example, the new they are really sizable. Okay, in 2018, for example, changing the tax code brought a loss of about $1.5 trillion, which is called the tax expenditures. Okay, and then here it's an itemized tax expenditure, basically some sort of revenues, changes in revenue due to exclusionary credits. If you are interested in the details. And there is a nice application where a new bill passed by the Senate in 2016 and the House as unanimous consent in the Senate and almost unanimous in the House, signed by Obama, President Obama at the time, renewed taxation of the prize bonuses earned by the Olympians. This is also, an interesting policy because it's not justified by all principles. Like this is basically, clearly income, and it's really very hard to make an argument in favor of it, like that this form of income earning delivers more positive externalities than the income of many groups who are taxed, such as, soldiers, social workers, and so on and so forth. So like, why are we removing the taxes out of these bonuses, right? Okay, so final section of this chapter is on the, as I have listed in the beginning of our slides, what is the appropriate unit of taxation? Like, the question is, what is, how the government should determine the appropriate unit of taxation? Like, the question is basic, should the government impose taxes on total family income or just on the incomes of individuals? It's especially important if you are married or if you are living together with someone. Because, like, in a sense, the tax brackets, all the tax tables that you see in the appendix of the individual income taxes forms changes if you are married or not, for example, or if you have a kid or not. Now the question is, like, you should have progressive taxes there or across family horizontal equity, across marriage horizontal equity. So it's impossible to achieve all these goals at the same time. Generally, like, if you are trying to achieve horizontal equity and progressivity, it is as if like you are imposing a marriage tax for some people, because it might actually, if you are living in a house of, suppose you are married and you don't have a kid. Now the question is, you can file taxes individually, both of you, versus you can file taxes as a married couple. Now the question is whether the tax that you owe changes if you choose a certain category. Generally, it turns out that, like, in total, if you, of course, this is a bit very complicated to calculate, but generally, if you are filing as a family, you may be paying somewhat more as if compared to filing as two individuals, which is called the marriage tax, basically. Especially if the tax system is progressive, which is charging higher levels of income at a higher rate. Because now you earn some money, your spouse earns some money, and in total you may be above certain brackets and then maybe paying a higher rate, as opposed to if you are just filing alone, you are not as rich, so you are not above that bracket and you are paying a lower rate. So therefore, the tax code should be really carefully designed so that just filing as a married couple should not put you in a disadvantageous position. Of course, it changes from country to country, and also it changes what kinds of income sources you have, capital income sources, labor income sources. In some families pay marriage taxes, it turns out. Again, it changes depending on your income. If you own some stocks, if your spouse owns some stocks, some rental income, and so on and so forth. So it changes, depending on the income, but generally, ideally, there should not be any marriage subsidy or marriage taxes. And why do we care? Because, for fairness contributions and, and United States is almost alone in having a tax system based on family income. For most of the OECD countries, including Turkey, it doesn't really matter whether you are a family or not. Like, you just pay your taxes on an individual basis. There's a question here. Okay, so there is a question from someone who missed the first 5 minutes of class, the final exam. So the final exam, the date has already been announced by the registrar. I think it's, so let me just finish up at this and then I'm gonna make the announcement. So yeah, actually we just, we are just done with our slides. So this concludes our lecture for today. Now let me make a very quick announcement about the final exam. One, so the registrar office already determined our final exam date. It's on May 14th. We are also given a specific time slot for it. But what I'm gonna do is that I will be, on that date, on May 14th, I will be posting the final exam on Courseworks in the morning. And then I will give you a certain amount of time to complete it, which is not gonna be less than 24 hours, okay? So I will make the announcements later on when the date approaches, but what's gonna be, it's gonna be very similar to the midterm exam, but it's gonna be posted on Courseworks. You will have a certain amount of time, which should be more than enough. So time is not gonna be an issue, don't worry about that. So you will download the final exam there, you will complete it, and then scan it and upload it back to Courseworks or Gradescope so that it could be graded. Okay, so that's gonna be, and you are, all the chapters that we have covered so far, you should know, but of course, you should give much more weight to chapters that we have covered after the midterm. I will also hold some additional office hours in case you may have questions about the final. Any questions?